It's early 2026, and the winner has already been decided. There's no crash, no emergency speech, no red banners across your screen. Your 401k might even be up, which is exactly why most people are missing it. For 3 years, you were told a different story. A recession is coming, housing will collapse, America is declining, China is rising, the world is going multipolar. It sounded dramatic, it sounded unstable, it sounded like decline. But here's what actually happens when fear rises. Money doesn't scatter, it concentrates, quietly. While cable news debates geopolitics, institutions move capital. While social media argues about decline, pension funds reallocate billions. Because when uncertainty increases, capital doesn't chase headlines. It runs towards structure. And if you live in America, that shift changes your mortgage rate, your retirement account, your job security. Here's the uncomfortable part. This shift started before any crisis, before panic, before headlines, before most people realized anything changed. Capital already chose its direction, which means the real question for 2026 isn't who looks strongest. It's which system fear still runs toward when everything else feels unstable. And once capital moves first, the rest of the story usually follows. In January 2026, there was no dramatic turning point, no Lehman Brothers moment, no pandemic lockdown announcement, no emergency broadcast, and yet markets began behaving differently. Sovereign wealth funds quietly shifted allocations, large pension funds trimmed exposure to certain regions, defense budgets accelerated, energy contracts were rewritten, supply chains were redesigned. Again, if you only watched headlines, you would miss it. But if you followed incentives, you would see the pattern. For the past decade, the dominant story was multipolarity, China rising, America declining, Europe fragmenting, the global South asserting independence, BRICS expanding. It sounded balanced. It sounded like decentralization. It sounded like a new world order. But watch what happens when volatility rises, when banks wobble, when regional conflicts escalate, when elections shake confidence. Money still runs in the same direction, not toward experimental systems, not toward alternative reserve currencies, not toward untested frameworks. It runs toward the dollar, toward U.S. treasuries, toward American equity markets, even when America itself is the source of political noise, even when people say it's declining. Behavior is more honest than commentary. That behavior tells you something important. Confidence is not about headlines, it's about structure. And here's where the contradiction sharpens. If you already own stocks, if you already own property, if you already sit inside asset markets, the past 5 years have likely treated you well. But if you're trying to enter the system now, it feels almost impossible. The average homebuyer is older than ever. Asset prices compound faster than wages. Wealth grows exponentially. Income grows slowly. Wealth compounds. Wages negotiate. And compounding always wins. And the longer you wait to enter the system, the further the entry price moves away. So you end up with two realities happening at once. One where charts go up, and one where everyday life feels tighter. Both are true, and that duality is not a glitch. It's a feature of how capital concentration works inside a system anchored to a single financial core. Because this isn't about who looks strong on television, it's about who benefits when fear increases. When risk rises, institutions don't search for ideology, they search for liquidity. They search for depth. They search for legal certainty. And there is only one financial ecosystem large enough and integrated enough to absorb trillions of dollars on short notice. That ecosystem hasn't changed, which means something else hasn't changed either, the gravitational center of the global economy. And once you understand that gravity, 2026 doesn't look chaotic anymore. It looks directional. If you follow capital long enough, you begin to notice something unsettling. It doesn't move based on loyalty. It moves based on gravity. And gravity isn't emotional, it's structural. In 1997, when Asian currencies began collapsing, investors didn't ask which country deserved support. They asked one question: where is the deepest market? Money fled to U.S. treasuries. In 2008, when the global financial system cracked, banks across Europe were freezing. Dollar funding disappeared overnight. And what stopped the panic? Not ideology, not diplomacy. The Federal Reserve opened dollar swap lines. Liquidity flowed outward from a single source. In 2020, when supply chains shut down, markets didn't abandon the dollar. They demanded more of it. That's the paradox. Stress does not weaken the center, it reinforces it. Because when volatility rises, institutions don't search for innovation, they search for liquidity, they search for depth, they search for legal certainty. And there is only one ecosystem large enough and liquid enough to absorb trillions in a matter of days. That ecosystem didn't appear by accident. After World War II, trade contracts were priced in dollars. Energy markets cleared in dollars. Global reserves were stored in dollar-denominated assets. At first, it looked temporary, but systems hardened, clearing networks, insurance markets, sovereign bond markets, settlement infrastructure. Layer by layer, the financial world wrapped itself around one core. And once infrastructure is built, it becomes self-reinforcing. This is why debt works differently at the center. When a smaller nation issues debt, it borrows. When the center issues debt, it doesn't just borrow. It manufactures the very asset the rest of the world depends on. The rest of the world uses that debt as the foundation for trade, derivatives, reserves, and interbank settlement. That changes everything. Because now debt isn't just a liability, it's plumbing, it's infrastructure, it's the mechanism that determines who gets liquidity when fear spreads. And once debt becomes infrastructure, the country controlling it doesn't just borrow money. It defines the conditions under which the rest of the world survives volatility. So when people say 2026 already has a winner, they're not talking about headlines. They're talking about structure. And structure moves slowly, but it decides outcomes long before the public debate begins. For the past decade, the dominant narrative has been simple. The world is becoming multipolar. China rises, Russia resists, BRICS expands, regional alliances strengthen. On the surface, it feels like balance. It feels like the end of American dominance. It feels like a new chapter. But multipolarity only works if power is evenly distributed. And power is not evenly distributed because geopolitical headlines are not the same thing as financial infrastructure. You can have multiple military powers. You can have multiple trade blocs. You can have multiple political alliances. But if global liquidity still clears through one system, if cross-border contracts still depend on one legal framework, if reserves are still anchored to one bond market, then the center hasn't moved. It has just become quieter. Consider this. Countries may trade more with each other than with the United States. Energy deals may increasingly be settled outside the dollar. Central banks may talk openly about diversification. But when crisis hits, real crisis, behavior reveals structure. During periods of instability, global central banks increase their dollar liquidity. Global investors increase treasury exposure. Corporations increase hedging through dollar-denominated markets. The rhetoric shifts. The behavior does not. That's because multipolarity at the political level does not automatically create multipolarity at the financial level. Building an alternative financial core is not about announcing a summit. It requires deep capital markets, rule of law trusted by outsiders, global settlement infrastructure, a bond market capable of absorbing trillions without breaking. That doesn't happen quickly. It doesn't happen because leaders declare it. It happens when the world chooses it repeatedly, under stress. And so far, the world hasn't. Multipolarity sounds inevitable. It sounds fair. It sounds modern. But what if it's mostly narrative? What if the appearance of fragmentation is happening on the surface, while underneath, capital remains centralized? Because if volatility continues to increase, if debt levels continue to rise, if geopolitical tensions continue to escalate, then the gravitational pull of the existing core may strengthen, not weaken. And that's the uncomfortable part. Multipolarity may exist in speeches, but structure determines outcomes. And structure is not democratic. And structure moves much slower than political ambition. If 2026 already has a winner, it's not because no one else is rising. It's because rising inside a system is not the same thing as replacing it. And until the core changes, the illusion of multipolarity may remain just that. An illusion powerful enough to distract from where power actually sits. Go back to Tokyo, back to that trading floor, back to those screens flashing red and green. Nothing about that room looks dramatic. No one is shouting. No one is panicking. But in that quiet room, decisions are being made that will quietly shape what happens in Ohio, in Texas, in California. Because when markets move, your retirement account moves. When capital shifts, your mortgage rate shifts. When risk reprices, your job security reprices with it. Most Americans don't wake up thinking about multipolarity. They think about rent, gas, groceries, the number in their 401k. They think about whether they can afford to send their kid to college, whether they can refinance, whether their savings will still mean something 5 years from now. And here's the uncomfortable truth. When volatility hits, when headlines scream about China, Russia, trade wars, elections, money doesn't ask who is rising. It asks one question: where is the deepest system? Where is the safest balance sheet? Where is the market that can absorb shock? And every time uncertainty spikes, capital flows back to the same place, even when that place is the source of the volatility itself. Not because it's perfect, not because everyone loves it, but because when fear spreads, institutions don't experiment. They retreat to what already works. But because when fear spreads, the world still trusts its plumbing more than any alternative. But because it's structured to survive turbulence. That's why multipolarity feels real on the surface. More flags, more summits, more speeches. But underneath, the financial plumbing hasn't changed. The pipes still run through the same core. And until that core changes, the winner of 2026 may not be the country with the loudest headlines, but the system that still absorbs global fear. Which means this story isn't really about geopolitics. It's about the architecture behind your savings, your debt, your currency, your future. Multipolarity might be the narrative, but stability, that's what the world still pays for. And in 2026, whoever controls that stability is already ahead. Multipolarity might dominate headlines, but structure writes outcomes. And outcomes don't ask for permission.